Well, we survived another winter storm. It's the end of the year. We're going to focus on some clear, concise, actionable items that you can do by the end of this year. Join us here as we talk through these.
Thank you for joining us today. We would like to discuss some year-end things that you can do to help perhaps minimize taxes, or at least have some high-level concepts as to what you can do here in the coming week or two. There's only really 2 or 3 weeks left until tax season kicks off, and so we wanted to make sure you at least have some ideas or some strategies to be top of mind as we near this end of year. Something else to be aware of is as you open the mail in the coming days, our tax organizer should be there. Please thumb through that, fill out at least the question and answers that we have. There's an engagement letter, but the Q&A is very important. That Q&A seems to get bigger every year as well, as we have tax laws changes, COVID-related questions. So I think that's up to 4 pages now of Q&A, but very important.
Yeah, and I tell a lot of people too, we send this package out for your benefit, right? You know, you don't feel like you have to fill it out. I joke, I have some clients that put it by the side of their bed and every single day fill out 1 page and they go through the whole packet. I have other clients that say, John, it's the best fire starter that you send all year long. That's what I do is I throw it away or put it in the fire. What we want you to hear from us is that checklist in the beginning. That's really important. If nothing else, the whole thing, if you focus on those 4 pages, that gives us as your tax preparers just an idea of some of the questions to ask. And the quick rule of thumb is if you follow through on those 2 columns, yes or no. If you're not sure, a yes means we're going to ask you a question. A no means it probably doesn't apply. And so if there's a question in that you don't quite understand, just put a question mark or put a yes there if you're not quite sure, because that's what triggers us to at least ask another question. It's not meant to be too invasive of questions. It's meant as just a guide for us to know what the next steps are for asking questions. So.
And a couple new ones specific to COVID would be unemployment benefits. So many more people received unemployment benefits. We're going to need to know that income, receive that document. Right.
And we may not have we're not looking for that, so we can't follow prior years for that. And it typically may not have had unemployment, but this year you did. So putting that as a trigger to, I need to look for those. That's what it's designed for.
In the stimulus payment. So we're going to be asking everyone, did you receive your stimulus payment of upwards of $2,400 for a family plus kids? So we're going to need to know that information.
Yeah, and I mean, as we look at it, 2020 was an unprecedented year. You've heard that, I'm sure, a ton of times. And so that's as we look at it, we are getting close to the end of the year here. We only have 2 or 3 weeks left. And that's why we wanted to come back for this video here, is just because there was so much unusual that happened. We've been racing through every single week, and so have you. You know, it's just crazy, crazy, crazy that we had to stop and hold ourselves back a little bit and say, wow, we need to take a moment here to think about these things at the year end, because if we look back from when we had unemployment or we had those stimulus checks, that was 6, 7, 8 months ago, and it seems like yesterday, but it was a while ago. And so those are just a chance here for us to step back, take a breather, and say, what are a few things that we can do here before the end of the year that could still make a difference for us? So.
Right, because we may need to shelter some of this unemployment income. Our business owners out there may need to shelter some of this payroll protection program income. So there are some last minute things we can do. One of those being charitable contributions.
Yeah, that's a great one. I mean, as part of the Stimulus Act or the CARES Act that came through, they gave us a $300 above the line item deduction for charitable contribution. It's an easy thing. $300 to an organization that's out there, and you get the deduction. Even if you take a standard deduction, you still get the benefit for it. So that's a nice little added bonus. It's not going to make or break anything, but hey, you might as well and get the benefit for it.
And what about those that don't itemize? Yeah, they're going to take that $300 deduction, but there's also what's known as bunching strategies. So I have been directing a couple people so far with year-end tax planning is maybe look at bunching 2 years worth of charitable giving here right at the end.
Right, and that brings up a good point here, is that bunching is, with the giving extra dollars to bunch, if you will, and push it, you may have consider whether or not you want to do a donor advised fund that gives you the ability to push all a bunch in 1 year and maybe not give the organization all of it all at once. But that's something to certainly think through, is to decide, and it gets into the idea with the itemized deduction. With that increase to the standard deduction so high now, you really got to ask yourself, is it worth doing these or not? In certain circumstances, it is. That's especially when you have these higher tax brackets that we're seeing right now. But for those of you that aren't doing the itemized deductions, this is a chance for you to step back and take a breather and say, hey, maybe I don't need to worry about all these items. Pulling receipts, pulling the things. If you look back at your last couple of years of tax returns and you see that we took the standard deduction, you may not have to spend all the time pulling your hair out trying to find those receipts. Or you may want to. That's that question. Give us a call, as Jeff mentioned there. You might want to actually itemize this year and push it through and get those extra deductions, and in which case you're going to want to pull all those receipts. But maybe you don't, so that's something to think through.
And as we move on here, John, penalties. So underpayment of tax penalties. That is something that we've been reading about this year, especially. We have been seeing in our own tax projections for clients, is the fact that some have made more money than we had anticipated back in February and March when we finalized the tax return. So along with that comes taxation and most likely not having paid enough throughout the year.
Right. So that safe harbor, that's something that we've talked through. We typically will put estimates out for a lot of our clients that you know that you're paying them throughout the year. If we were to look back in March, April, May, when we were sitting here wrapping up your last year's tax return, it was doomsday. I mean, we were thinking the world was going to come to an end, things were going to shut down and just come to a halt. We may not have created estimates for you because we didn't know what business was going to look like. Well, in hindsight now, all of a sudden, we're feeling income came through, things maybe come back. You got to pay attention to this because there's a chance that you are taxable, and then the IRS would want you to pay those estimates during the year. These are things you need to be thinking about and looking at. So that's what we're talking about there with the underpayment of penalties. You know, we jump right into this, but what we're following through here is this action item. It's a 2020 end-of-year action items. This came in that organizer that we sent to you. So we were following through this just so that way is an idea that you can look through. But take a look at this and check these off. They're meant to be a very straightforward. These are some quick things that you need to be thinking about before the year end. So that's what this is here for. So.
And how does one know that they're underpaid in the first place?
What you'll look at is you're going to look at your prior year tax return, and if you made more than $150,000 from an AGI, then you have to have 110% of your prior year taxes paid in during the year. If you made less than $150,000, you have to have at least 100%. Or the short answer, give us a call.
Right.
That's
right.
The easy answer. So, but what they're trying to do is the IRS wants you to pay during the year. So if you think about it, as an employee, they withhold every single paycheck that you get. They withhold during the year. So if you're a business owner, you can't just wait until the very end of the year to pay. You have to pay during the year. So that's fundamentally what you're trying to get to.
So really just look at last year's tax return. What was your total tax liability? Compare that to what you think you have paid throughout the year. Mm-hmm. If there's a difference, meaning you haven't paid 100% at least, you're in a penalty position most likely.
Right. And penalties aren't bad, right? A penalty is think of it this way, is it's a loan from the IRS. So it's not the end of the world, but in a sense you're taking a loan from the IRS. So a 6% loan or so look at it. So you want to be aware of it, at least make the decision as to why you're doing it. That's the fundamental thing. It's not going to make or break anything. It's not like you're going to get notices from the IRS and the bells and whistles and the cops are going to come. But it's one of those where you want to at least know what you're doing with that. So.
And if you think you are significantly underpaid, you should give us a call because there's a couple strategies. One being, if you are in control of your own wages, maybe you're a business owner or you know you have a bonus coming at the end of the year from your employer, you can have your withholdings temporarily increased to help cover this underpayment. Another popular method is if you are retired, you want to pull some money out of your IRA or 401k here in December, you could also increase the withholdings from that payment and just to get caught up and limit that underpayment penalty. But I would say only do that if you think you are significantly underpaid.
And if you're looking at doing that, give us a call. I mean, we're doing that pretty normal course of business right now with a lot of our clients that we're talking to, the business owners and otherwise. But ask us. It's a trick that you can do by doing those withholdings and adjust it. And it treats it as if it was happening all year long. So it's a good little trick there. And here's an age-old adage of make sure you're maximizing all of your tax deductible deferrals. So your 401ks, your IRAs, your HSA accounts. Those are, I call them the alphabet soup of saving. Think through those. Some of those you don't have to make those in until April. Some of them you have to make in December. So kind of think through, am I going to be maxing in my 401k? That has to be done in December, whereas an HSA is in April. So you're allowed to pay those later. But at least budget for them now and be thinking about those now. And we say that because a lot of individuals are going to find that they are in a higher than normal tax bracket just because of the year that has come through, because of the unemployment or the PPP or other things.
Some stimulus money that has been taxable.
Yep.
And I would also add, some of your last year's income had been reduced because you had already maxed out 401k plans, let's say. This year you may have held back just because of the economic uncertainty.
Mm-hmm.
So you may find yourself not having put in as much as you did the year before, which means you may exacerbate the underpayment situation.
Mm-hmm.
So on and on it goes.
Yeah. It's stifling the amount of downward spiral that we're seeing where people are pulling dollars or saving dollars and what that means and how that impacts taxes. It's definitely need to be thinking about this if you haven't done it already. So.
Maybe it's not on our agenda here, but maybe we should mention the COVID-related draws from an IRA or qualified retirement plan. That could be really helpful if you can certify or you can qualify that you needed those funds for a COVID-related cause. And there's 3 or 4 bullet points on that. Just talk to us. But if you qualify for that, you could pull money out of a retirement account and spread that taxation over a 3-year period. If you're under the age 59 and a half, you normally would be subject to an early distribution penalty. That can go away if it's COVID-related distribution. So that's something a tool we have up our sleeves here that can really help taxpayers.
Yeah. And we've been stressing this all year long. This is nothing new, this tax planning. This is definitely a year that you need to be thinking about it. You need to be aware of it, and you need to know your situation and where you're at. And I say that because individuals are oftentimes shocked this year of what's taxable, what's not taxable. But they're also very aware of the fact that age-old adage of tax saving has us deferring as much tax as possible. So everything we've talked through thus far in this video has been ways to avoid taxes, right? To charitable contributions, itemized deductions, bunching, all these things are avoiding taxes for right now. The flip side of what we've been dealing with, and I've also talked about this in other videos, is we're looking at a likely increase in taxes in the near future. And so we should be thinking about, well, the flip of this, and maybe we want to actually be recognizing some income. I get we're talking out of both sides of our mouths here. So we're saying on one hand, save taxes, on the other hand, pay taxes. But it's that balance, and every individual is different in this case. So that's the key, and that's what you need to hear, is that you need to be doing tax planning. Because for some individuals, it's going to be about deferring those taxes because you're in a higher than normal bracket. Others, it may be saying, whoa, you're lower than normal because you actually had a down year, or because we didn't pull RMDs, or we did other things that were lower than normal, and we want to actually increase your income. We want to recognize some capital gains at the 0% rate, or we want to actually do a Roth conversion on the traditional IRAs so that way we can take advantage of some lower income to shelter it in the future. So I'm seeing it all across the board, from saving to recognizing it earlier. So the key there is look at your own tax situation and be thinking, do I want to lower my income, or do I want to raise my income? Where do I want to know it? The key there is you should know it. I'm using the words know your rate. You should know what tax bracket you're in and why you're aiming for a specific income, either up or down, so that way we can level it out year over year.
So a lot of times we're trying to optimize a bracket.
Right.
So it's knowing where am I usually at, where will I be at the end of this year? Will I be above or below my average tax bracket? And then plan accordingly.
Yeah, we never want to have too high of income or too low of income, because if you're too high, you're paying extra taxes that you don't need to, and if you're too low, you're giving away deductions that you might not be able to get back. So we want to be nice and level. I mean, accountants, we're a conservative bunch, right? We like things steady Eddie. 2020 is not a steady Eddie year, that is for sure. So if you want to talk about a bunch of stressed out people, look at us. I mean, we've been dealing with it, as have you, but we've been up and down and trying to figure things out here. And so this is what you need to hear, is that in a year of so much ups and downs and uncertainty, stepping back and taking a look and really deciding where you're at is pretty key. These items here we've talked about, these are easy items to be able to just checklist right off the bat and say, do I need this, do I need this, do I need these? That's what the intent here was. But hear from us, give us a call. Work through it. If we haven't a right talk with you, call us. That's what we want to do, because it's certainly easier to deal with it now than it is to deal with it after the year end.
Right. We really don't want you to have any tax surprises. That's our main goal, and we can't always avoid that. But at the same time, if we understand the reasons, the impact, then I don't know, we seem to be able to handle it better.
And you know, it is often when we're talking with our clients that they owe taxes. They had a good year, or you know what, you have more cash right now than you anticipated. And so now is the time that you're going to take it as income, and it's okay. That is a choice that you can make, but it's a whole lot different of knowing that you're going to owe them than have it be a surprise. That's the key. It makes it a whole lot easier to pay those taxes if you know about it ahead of time, because then you can make a conscious decision and you're the one in charge as to whether or not you do want to pay those taxes, or do you want to invest in something else to lower those taxes down. But it puts you in the driver's seat versus the other way around.
So overall, I'm thinking our business owners, our self-employed people, they seem to have the most control over taxation versus an individual. Individuals have some strategies. We talked about it a little bit. Contributions to retirement accounts is one. Health savings accounts, if you're eligible, maxing that out could help.
Recognizing some capital gains. There are a lot that individuals can do, but those are ones that you have to consciously think about it. Or as a business owner, you tend to think through on a regular basis, am I going to buy the equipment or not? It's a normal thing. As an individual, you may not think about, oh, well, I want to recognize some gain on my GM stock or some of these other things. I mean, everyone has stocks that either may be way down right now or way up right now, and we actually want to recognize some gain. So there are strategies that we can do.
So that would be getting together with your financial advisor as well, maybe even an estate planner. You know, if you haven't updated your trust document in a while, look at your beneficiary designations that you may have on your IRA accounts, other retirement accounts. All that's very important, especially during these times of uncertainty.
Yeah. Well, we've given a lot of information here, and we tend to do that as in videos. So what we're trying to do with this checklist here is to make them very clear, actionable items here by the end of the year. We've got 3 weeks left. Be intentional about those 3 weeks. Know where you're coming, know your rate. Give us a call if you want to talk through it, but you be in the driver's seat versus having it be in arrears. Know what you're doing and know what you're coming forward to. We thank you for taking the time to listen to us. We look forward to talking to you in the near future. Thanks for listening.